The Great Depression is the worst economic downturn in the history of economics. I mean, we've had some bad financial issues in the recent past, but really nothing to compare with the Great Depression. It's difficult to imagine the Great Depression occurring without the First World War. In fact, John Maynard Keynes, who you need to know later as an important economist of the post-war period, was an attendee at the Treaty of Versailles, and he wrote a famous book at the end called The Economic Consequences of the Peace. And he predicted many of the problems that occurred in the post-war world because of the economic and political decisions that were made at Versailles. The Great Depression has important political implications. This was supposed to be a great age of democracy as new states, Democratic and Republican states, were created out of the former empires. Indeed, there were more democracies in the world in 1919 than there ever had been before. But most of those democracies were gone. Only 12 were left on the eve of World War II, and a major reason for that is the impact of the Great Depression. Essentially, it stimulated the growth of extremist movements. So I want to talk briefly, a little economic theory, but not too much. Don't worry about it if you're not really schooled in economic theory, as to why the post-1919 economy was in such bad shape. So usually unemployment and inflation work in opposite directions. This is not the case in the immediate post-war world. You had both high unemployment as returning soldiers tried to re-enter jobs that had been taken by other people, including women, but also high inflation because of government spending on obviously the war, the government issuing bonds, which drives up the cost of money, interest rates to attract people to invest. And so you had both of those working in the same direction, as we did later in the 1970s with what's called stagflation. The worst example of this, and this is a unique situation, is the hyperinflation in Weimar Germany. After the French invaded the Ruhr Valley, the government depreciated its currency to try to pay off reparations and also the workers who were on a campaign of nonviolent resistance. And by November of 1923, which is when Hitler attempted to overthrow the Bavarian government in the Beer Hall Putsch, the Deutschmark was worth one Deutschmark, or there were 4.2 trillion Deutschmarks to equal $1, which when before the war even started, it was 4 Deutschmarks per dollar. So because of U.S. policies, which I'll explain in a moment, from 1924 until 1929, there was a temporary recovery where a lot of optimism was in place that finally the economy had returned to its pre-war status. But as future events would reveal, this was a very shallow recovery and based on a lot of speculation in the stock market. So the Great Depression was triggered by the collapse of the U.S. stock market in October of 1929, and since Europe was so dependent on U.S. capital, which was now quickly evaporating, Europe would too, and not to mention the entire world was plunged into the Great Depression. There are very few regions or states that benefited from the Great Depression. So this is a little mnemonic device on some of the structural problems in the economy. At first, there were strong inflationary pressures for the reasons that I just mentioned by the pressures of the war. But I do want to emphasize, we tend to think of inflation as being negative. For the example of Germany, inflation basically robs the ability to pay for goods, okay? By the way, inflation is good for debtors. So if you owe somebody some money, you want easy money to expand the money supply. So imagine like you owe somebody $10 and before the inflation strikes, let's say that $10 can buy 10 candy bars because each candy bar is $1. Now because of inflation, let's say candy bars by the end of the year are $2, okay? So you pay back your $10, but now that $10 only buys 5 candy bars. So this is also goes into the history of the United States with the gold standard versus coining money based on silver, okay? So in the Great Depression, what actually occurred is deflation. You do not want deflation. What you want is a slow and steady inflation. So the Federal Reserve of the United States aims for an inflation rate of somewhere between about 1.5% to 2% and allows the money supply to increase along with that. Deflation is basically a sign that the economy is seriously dysfunctional and people are in a state of mind psychologically where they don't want to expand businesses and they don't want to buy anything. So this inflation would turn into deflation when the Great Depression eventually struck. Part of this had to do with a glut of commodities on the world market because of new entrants into the markets because of Europe's privileged position before 1914 was gone, okay? Whether that's parts of Australia, New Zealand, China, Japan, India, the United States, North America, South America. So especially in agricultural products, this was a terrible decade for farmers. And then we throw in the United States with the Dust Bowl, and you can get the picture that it was not a good time to be involved in agriculture. And then this artificial flow of capital, starting with the United States, loaning money to Germany so that Germany could pay off reparations to France and Great Britain and Belgium, etc. And then those countries paying the debts they owed to the United States. This created this like circular flow of capital upon which the entire world economy depended. And when that was ended, like sort of like a bicycle spokes, and somebody puts a stick in the bicycle spokes, and the person riding the bike goes, head over heels onto the ground, that was the stock market crash. So as I mentioned before, the sort of like golden age, obviously from the European perspective, of a world market dominated by Europe with stable currencies, low inflation rates, low interest rates, that was all gone because of the disruption of markets with these new centers of power. And then to respond to this situation, to protect their workers from unemployment, governments began to enact high tariffs, the worst of which was the United States Smoot-Hawley tariff in 1930, the highest tariff rate ever. So the hinge here really is the relationship between reparations and currencies. So most countries tried to go back on the gold standard, which ended up being a bad idea. So literally at the time, you could bring your banknotes into a Federal Reserve bank in the United States and get gold back. People didn't do that because it's very inconvenient to be carrying gold around as a medium of exchange. So if you trust in the value of the currency, there's no need to do that. But if you don't, which is what happened during the Great Depression, then gold is draining out of your treasury. And this eventually forced the two financial leaders in the world, the UK and the United States, to go off the gold standard by 1934 because their treasuries were being drained of gold, which is a sign of deflation because people are not trusting that this currency is worth anything. All right, so these currency values affected the ability of countries to trade with one another. And so when the Great Depression hit, there were actually, in some instances, a return to a barter system because people didn't want the like currency of another country because they didn't think it was worth anything. So literally you had countries trading one commodity for another commodity. Actually, France was much less affected by the Great Depression because they undervalued their franc, whereas the British overvalued their pound because they wanted to return to their situation as global financial leader, which they couldn't. So France certainly experienced the Great Depression, but not nearly to the depths of other countries. And so eventually, as I mentioned, countries were forced to go off the gold standard. Okay, I will just add as a little footnote that with U.S. leadership after World War II, the gold standard was returned. However, the United States again went off the gold standard in 1971 because of inflation caused by government spending and also the Vietnam War. So we are not on the gold standard. Some people think we should go back on it. Many people think that would be a terrible idea. All right, so the United States, even though it was obviously involved in the First World War and it was selectively involved in the European economy, it really refused to take on the role of being global financial leader. And this is because it didn't take the wisest policies. Its policies were kind of narrow-minded and self-interested without thinking about the overall global economy. So one way the U.S. got involved in 1924 to end the Ruhr crisis and the hyperinflation is they extended a loan to Germany called the Dawes Plan. And this is what set up that cycle of capital flow. Okay. This was later added in 1929 to even extend the payments out even further, which if this had been followed through, would have meant Germany was paying off reparations into the 1980s. This Young Plan was very controversial. The Nazis made hay about it because it seemed to basically, from their perspective, put Germany in a situation of indentured servitude until the 1980s. So U.S. policies, the United States should have had open borders. We should have allowed Germany, Great Britain, France to easily access U.S. markets to sell their goods. Why? So they could earn the money so that they could pay off the reparations in Germany's case and pay back the loans that we had given them during World War I in the case of France and Great Britain. By the way, for the first time in its history, the United States in 1914 became a creditor nation. We had historically been a debtor nation. By the way, we once again are a debtor nation starting in 1986. Okay. So also, the Federal Reserve under Republican administration of Coolidge pursued an easy money policy, which allowed more money to go into banks so that they could loan that money, which fueled the speculation in the stock market and the purchasing of stocks on margin, or basically borrowing most of the money in the hopes that you could pay it off later, which is fine if the stock market keeps going up. But it became clear that many of these corporations that people were bidding up, a lot of new technology stocks, General Electric, Westinghouse, automobile companies, appliance companies, were being bid up way beyond the possible value that they had, like you saw recently with GameStop. And so eventually somebody realizes there's no way this can be sustained, and then they start to sell. The psychology starts to kick in, and then you have a bear market and people start to sell, and then you have panic selling as you did in October of 1929. So the most notable feature of the Great Depression is massive unemployment. By the way, our unemployment rate now is probably like, I don't know, probably 6 or 7%. And that's largely because of COVID. Before COVID, it was down to like the lowest point it had ever been, basically in the 20th century, around 4%. So if you can imagine like 33 to 40% unemployment, that means somebody in your family is probably unemployed. Your neighbors are unemployed. And what happens here is it creates a vicious cycle downward. Fewer people are working. That means they're spending less money. People are cutting back their budgets. That means businesses have no reason to expand or to produce. So they have to lay off workers, which means the spiral just continues downward. So the two hardest hit countries were the United States and Germany. Investment dries up. Why would you borrow money so that you could expand your business or open a new business, as we see with COVID? I mean, what a terrible time if you just opened a restaurant, right, like in the spring of 2020, to open a new restaurant. Terrible time, right? Because who's going out to restaurants when you're not allowed to actually sit at a restaurant? So all of this created a massive bank failures. So this started in the United States and then rippled across Europe. And in fact, one of the most important banks in Europe, the Credit Anstalt in Vienna, failed in 1931. And when one bank fails, since they invest in each other's banks, other banks begin to fail as well. So you also had protectionism and tariffs, which caused world trade to plummet because every country is trying to protect its markets. So looking at the responses, they were not terribly effective. So most people pursued classical economic policy, deflationary policies, and budget cuts. So this is exactly what later on John Maynard Keynes said what you shouldn't do. You don't try to balance your budget during hard economic times, because what you need to do is like what's called prime the pump, is you need to start spending money, cutting taxes and increasing government expenses so that people have money into their hands, working on the demand side, increasing demand, which will then stimulate the economy. And then when the economic times are better, then you can start to balance the budget. So Keynes laid this all out in 1936. So finally in 1931, the reparations payments were canceled. And by the way, Hitler, when he came to power in 1933, just rejected them and saying we're not paying any reparations. So the British pound collapsed in 1931 for the reasons I already gave you, because of the drain of gold from their treasury. The United States, like I said, also had to devalue the dollar in 1934. So the democracies kind of muddled around. They didn't really have a clear economic theory. Most of them tried laissez-faire. That didn't work. They tried a series of different kinds of reforms. There were also some popular front governments of like unifications of leftist groups, socialists, communists, and others in countries like France and Spain. They might have helped ameliorate some of the problems of the Great Depression, but they didn't fully solve it. The United States experimented with this New Deal, which you've probably heard of. That helped lessen the impact of the Great Depression, but it didn't take us out of the Great Depression. In fact, we had a really bad recession in 1937-38, where the unemployment rate went back up to the worst days of 1932 and 33. So really, it was World War II that brought many countries, particularly the United States, out of the Great Depression. So what impact did this have politically? It led to the rise of extremist movements in most of the countries that had been created in Central and Eastern Europe. And obviously the worst case is Germany. So the Nazi vote in 1928 was basically less than 3%. However, by 1930, 1 year after the Great Depression, the Nazis had moved up to 17 to 20% of the vote because they were able to exploit discontent over the Great Depression. So this is definitely one of the props leading to the rise of totalitarian governments. Okay, so the Great Depression, important topic, economic, but also related to politics.